In general, fiat currency systems are like musical chairs. The system only works while it's moving, right? As soon as it kind of stops, it doesn't work well. Current systems like a house of cards in the sense that there's far more liabilities for every base unit, which is like a game of chairs where there's like 20 kids and one chair. We saw that attempted at the global financial crisis back in 2008, 2009. Instead of letting that go down, they pulled out the printing bazooka because you can't let that kind of Ponzi collapse at once. They don't want this like $120 trillion debt pile collapsing down towards 6, especially these creditor nations. They've got this big war chest of U.S. assets that they can sell and kind of break U.S. capital markets. Gold in the central bank's own self-custody is attractive as a sovereign asset. The U.S. and more broadly the West was the center of everything. And now we're kind of going back to the state that existed prior, which is that there are multiple poles in the world.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Jordanov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Today I have the great pleasure to welcome back Lyn Alden, who is a recurring guest. Welcome back, Lyn.
Happy to be back. Thanks for having me.
I really am looking forward to the conversation because we'll dive deeper into how the US dollar system is slowly shifting, also more and more power consolidating towards the east, but also what the ramifications are of all that system shift. So my question to you as well would be, if you imagine you're in the year 2050s, quite in the future, and in the history books, they'll put a chapter about exactly the times we're experiencing right now. What would this chapter look like? What would it be called? And what would the set of events be describing?
I'm not sure they call it, I guess, something like the acceleration of the realignment. And I think it's a period of time rather than any one incident. So, for example, when people look at past kind of big changes, like say 1971, they can point to 1 year and one date that they can kind of emphasize, or kind of similar things with the Great Depression. I think this period is more punctuated by multiple events. I mean, obviously, this decade kind of kicked off with a bang with the pandemic lockdowns, then the massive fiscal stimulus, and then like military engagements, kind of these big conflicts. And now rather major attempts at kind of fixing global trade and realigning that. So I think this will be seen as, especially if historians really dig into stuff, an acceleration of things that were already underway. And so there's already been, back in the 2010s, a very gradual shift east and a very gradual change in, for example, neutral reserve assets, in central bank holdings, reliance on the Treasury, security as a core holding. These things are already kind of gradually shifting. And this decade kind of kicked everything into high gear and brought it up to the mainstream and brought it up to kind of the main event. That's probably how I think this decade, at least so far, will be looked at.
And of course, at the core of this is, you just mentioned it, so it's a recalibration of trades. There's a lot of talks about this. I had a lot of the past interviews I've had with many thinkers about exactly this topic, because it also seems to be very fundamental in the way the monetary system in general, or global trade, will look like in the decade to come. So how would you resume it at best? What incited this profound change in the way this global realignment in trade looks like today?
I think what incited it is cumulative effects. So there's not one thing that incited it. It's the system itself incited it, because the system itself was imbalanced. And so a way to put that is to say, these trade deficits have been in place for decades. And 1 or 2 or even 5 years of trade deficits are not really a giant deal. But 3 decades, 4 decades, that becomes a really big deal of just consistent trade deficits from the United States. And the way that I've characterized this before is that it's directly tied to the current structure of the global reserve system, which is to say that there's all this foreign demand for dollars because it's the global reserve currency that's used for things outside the United States. It's used for cross-border funding. It's used as a reserve asset. It's used as one side of 90% of foreign exchange trading pairs. It's used for international contract unit of accounts for the most part. So there's all this kind of excess demand for it. And what that does is that overvalues the dollar on a trade-weighted basis, which gives Americans really strong import power, but then gives manufacturers and other low-margin exporters in the U.S. basically a disadvantage. It's more expensive to manufacture there, let alone compared to developing countries, but even compared to other developed peers in Japan and in parts of Europe and those places. Another way of looking at it is that the whole world needs dollars if it's going to be the global reserve currency. And then the question is, well, how do they get dollars? How do they have trillions of dollars floating around the world outside of the US to be the global reserve currency? And the answer is trade deficits, structural trade deficits. So by overvaluing the dollar, it basically spills open dollars to the rest of the world. And so the US gets all these advantages from being the issuer of the global reserve currency, but then some parts of the US get the disadvantages. It gets a hollowed out industrial base. And this builds up kind of resentment for years and decades. I mean, basically, we saw a literal movement of wealth from the Midwest industrial zone in the US toward the coastal cities that basically issue securities and benefit from that recycled wealth. So we're basically shipping out our industrial base and having it come back into our financial markets. And that over time builds up a sense that something's wrong, something's imbalanced. And so over time, the trade deficit is like a minor political issue. It's not really touched upon. Then, for example, in Trump's first term, it was like a minor issue. Like he brought it up. He's long been focused on that topic, but he brought it up, and it was kind of a backseat compared to other things in that administration. But now in his second administration, it's kind of front and center, and it's a main political event now. And I would say this is because of accumulated issues. In a similar way, when the U.S. went off the gold standard, people think of it as an event, and it's easy to point to obviously one specific day and one specific year. But one thing I've emphasized is that that problem was building throughout the 60s. So 1971 represented a breakage and an acceleration of a problem that was already occurring, which was that there was way more dollars being created compared to how much gold reserves the U.S. had. So it just you could kind of graph it and see it kind of slowly getting unbacked until it kind of broke all at once from a political decision. And while this is not quite that compressed, it's not like one event. This is a result of accumulated issues that are now kind of front and center all of a sudden.
So now if we look at and focus about what the Trump administration has been preparing for the last couple of years and now putting to action, first of all, maybe let's describe what the strategy is and how it's actually working out at the moment.
Well, I think there are multiple strategies. I mean, they have more than just the trade situation going on. They have the attempt at fiscal consolidation, Doge. I would say that so far that's going poorly in terms of the fact that deficits, federal spending is higher so far in the first 4 months of the year than prior 4 months and most other 4-month periods outside of the main pandemic stimulus years like 2020, 2021. So I'd say that's not going well. The part that they are making more waves on is the trade front, and that's far from over. So that's yet to be kind of fully written, I would say. And I think the best playbook to look at is Stephen Myron. He is Trump's chairman of his Council of Economic Advisors. And he wrote a paper back in November 2024, so right after Trump was elected, and he had been working on it obviously before then. And he is, PhD in economics from Harvard, a trained professional that studies this. And he kind of laid out like the problem, like what I just described about the dollar being the global reserve currency and therefore having a negative effect on U.S. Ability to export things and overall trade balance and industrialization. So he highlights that issue, and then he kind of analyzes different way to go about fixing that. He looks at tariffs as an option. He looks at ironically putting a tax on U.S. financial assets or a fee on U.S. financial assets to discourage excessive reserve accumulation of dollar-based assets, which you wouldn't see many politicians talking about, saying we want the world to own less of our stuff because overvaluing our dollar. But that's something he brought up in the paper, and he kind of tackled both sides of that, as well as like the idea of multilateral currency accords, something like the Plaza Accord of the 1980s. This would be a Mar-a-Lago Accord if it were to occur, because it's usually named after the place or the hotel that the agreement takes place at. Maybe the Geneva Accord, we'll see. And he kind of goes all those different solutions. And I think the challenge is that because it took decades to build up, it inherently takes at least years to really start to meaningfully change the course or something like that. So I would describe the playbook as interesting but flawed, maybe overestimating the US's negotiating position. And then I would describe the execution so far as rushed, and therefore more disruptive than it had to be, and kind of self-defeating in the sense that the levels of initial tariffs that were put on the U.S. were as harmful to the U.S. as to China and elsewhere, meaning that the U.S. had to kind of negotiate against itself in some ways. But this is still far from written yet. I mean, even in the past 48 hours, there's news about pausing some of the tariffs between the U.S. and China, making progress on that. So we'll see how that goes. But I think that again, this is a acceleration moment. It's not a single time where, like, say, we see trade totally reverse, trade deficits close. This is more like the first serious attempt at picking away at a very strong network effect and maybe starting to gradually change its direction.
So you've actually talked about musical chairs in one of your past newsletters about the fact that with over $100 trillion liabilities and only $6 trillion base dollars, we're essentially running a global dollar-based musical chairs game. What do you mean by that?
So in general, fiat currency systems are like musical chairs in the sense, and for people that, most people are familiar with that game, but basically it's like a children's game where you play music. There's, say, 10 kids walking around 9 chairs, and you stop the music, and they all have to scramble for seats, and 9 of them will get seats, and one unlucky kid won't get a seat. Then you remove it. That kid's like kicked out of the next round. You take a chair out, so then there's 9 kids and 8 chairs, and you keep going until there's one kid left. And the whole point of that is that the system only works while it's moving, right? As soon as it kind of stops, it doesn't work well. If you had a low debt equity based system, it could mostly stop, and it wouldn't be great, but it wouldn't like completely implode on itself. It's not a house of cards. It's like a house of bricks. Whereas the current system's like a house of cards in the sense that there's far more liabilities for every base unit, which is like a game of chairs where there's like 20 kids and 1 chair instead of like 10 kids and 9 chairs, right? So the ratio is dangerous. And what that basically says is that, so there's in the U.S. we have $100 trillion owed in dollars, so liabilities of dollars, and yet there's about $6 trillion in base dollars. And so you have a very high leverage ratio. And then outside of the US, there's nearly another 20 trillion in dollar liabilities, mostly not even owed to the US, owed between other countries. And there's only so many base dollars floating around outside of the US or ways to access base dollars in the US. And so this is a system that is kind of built to, it runs into issues, and then they inevitably print more dollars whenever there's a major issue, because they don't want this like $120 trillion debt pile collapsing down towards 6. We saw that attempted at the great global financial crisis back in 2008, 2009. Instead of letting that go down, they printed. In fact, if you look at that 100 trillion I referenced of domestic debt, if you look at like the 70-year history of that nominally went up every single year, with one brief exception for about 18 months in 2008, 2009. It was the only time it ever didn't go up, and it went down like 1%. And then they pulled out the printing bazooka, because you can't let that kind of Ponzi collapse at once, is how they view it. And the point is, although that's been somewhat deleveraged compared to 2008, 2009, just because of the sheer amount of base money creation since then, it's still highly levered. And then where this impacts trade is basically because the U.S. has run decades of trade surpluses with the U.S., deficits for us, surpluses for them. They've accumulated tens of trillions of dollars of U.S. assets.
Sorry, you meant with China or the U.S.? Because you said deficit with the U.S.
Yeah, so deficits from the U.S. perspective.
Okay, yeah.
Surpluses to the rest of the world, including China, but not just China, Taiwan, Japan, Germany for long periods of time, multiple other countries, Switzerland. they've accumulated collectively massive surpluses, and then they generally reinvest them in U.S. assets. They own U.S. stocks, something like 25% of our stock market. They own corporate credit. They own Treasury debt. They own all these assets. And if they're ever short on dollars for their liabilities, especially these creditor nations, they've got this big war chest of U.S. assets that they can sell and kind of break U.S. capital markets to try to get their hands on dollars because there's so many claims for dollars compared to base dollars.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. So I had this conversation with Hugh last week, and he was mentioning that in the end, the whole story around China dumping treasuries is BS, meaning that all of this US-denominated debt resurfaces or comes back into the Chinese system because the Chinese want a low yuan in order to export it, in order to keep their middle class richer, but not too rich, so not to threaten the whole system of leadership and power in place in China, and thereby find other ways to get this US dollar back into their hands because they need this liquidity to keep the yuan low. What do you think of that? Is that making sense to you?
I would characterize it somewhat differently. So partially, so people describe it as dumping treasuries. I would say trimming treasuries. And it actually goes back prior to Trump's first term. It goes all the way back to somewhere around 2013, 2014. And that was when they announced the Belt and Road Initiative. They literally announced that accumulating treasuries is less than their interest now. And they also announced Belt and Road Initiative, which is basically using funding to basically develop a lot of their trading partners in some ways, infrastructure, commodity deposits, supply chains, things like that. And there's been a little bit of recycling by some estimates where there's less on the Chinese balance sheet, but then there's more in other foreign balance sheets that might be owned by China. So a little bit of kind of shell games going on. But even when you kind of include the higher estimates for that, it doesn't really make up for the downward trajectory that we've seen in Chinese treasury holdings. And another way I'd put it is that not accumulating is actually kind of the same as dumping because ongoing inflation happens, ongoing debt issuance happens. And for example, if you look at the past 10, 15 years, the percentage of the treasury market owned by foreigners has been going down because they've been collectively going up very slowly compared to U.S. issuance. So there has been somewhat of a repudiation of U.S. debt. It's not like a shock at all selling. It's just kind of silently not buying like they used to be. And China's been one of the bigger kind of linchpins in that because they were a huge accumulator in the 2000s decade, and then once they got into the early mid 2010s decade, that's no longer the case. As for the second part, I think that they're trying to have a mid-strength currency. So they don't want a particularly weak currency because they are trying to internationalize their currency. They're trying to make, they're the biggest trading partner with most countries in the world now. And they're basically trying to go to their trading partners and say, look, if you hold, Chinese currency bonds, those are money good. You can buy electronics with them. You can buy cars with them. You can buy all sorts of stuff with them. And we're not going to rapidly debase them, at least compared to something like the dollar and other debasing currencies. So I do think that they are trying to make a kind of a catalyst or a reason why you'd want to hold their bonds rather than just hold treasuries. Not because they want to displace the treasury. They don't want the problems I mentioned of like Triffin dilemma and structural trade deficits to support it. But with their own major trading partners, they do want to internationalize it in the sense that they want to be able to buy energy in their own currency. They want to be able to trade with their own currency with their biggest trading partners. And that basically means making the currency solid enough. Now, they don't want the currency to be so overvalued that it hurts their export business. but they're already very geared toward exports. So I think they're basically trying to maintain a rather balanced currency compared to the dollar. Not too high, not too low, kind of Goldilocks, just right. I think that's their approach. And yeah, if they ever gets too strong, one of their options is reserve accumulation. And if it gets too weak, I mean that's why they use capital controls. They can sell reserves to buy back their currency. They have these kind of different levers they can pull to either weaken it a bit or strengthen it a bit over time.
One could argue that, I mean, we just mentioned like the internationalization of the yuan, but as you just also mentioned, it's also there's a lot of capital control. So how would that fit together? Would there be maybe a proxy where they would use the Hong Kong dollar as a way to be able to take that share away from the US dollar? How do you see that?
Well, one is just by running a current account surplus as they do. That's good for a currency. Now, there's other things that are negative for a currency, which is, let's say, weaker rule of law. So if you're wealthy in China, there's been a pretty strong incentive to try to get capital out and put it elsewhere. Buy Vancouver real estate or, real estate in Australia or U.S. stocks or, whatever the case may be. There's been this kind of view that for whatever reason, my stuff could just be confiscated or rules could be changed, and I'd rather have some capital outside of the borders. So current account surplus is good for currency. Other things are kind of negative for the currency. Anytime they use stimulus, it's kind of a mixed bag. And so, yeah, one of the levers they can pull if they ever feel like their currencies get too weak is they tighten up their capital controls a little bit. Approach is just selling some of their reserves and buying back some of their own currency. We saw Japan do this when the yen had its kind of weakest moments against the dollar, back when the U.S. was still raising rates very sharply. During the kind of inflation period, Japan was not raising rates, and so you got this kind of wider than normal differential between interest rates. The yen was weakening pretty significantly, and they would occasionally sell a few tens of billions of treasuries and break some shorts and buy back some of their own currency. And China has the same capacity. And if they want to weaken their currency, they can always, print more currency and buy more reserves. And I think over time we're going to see a gradual opening of Chinese system a little bit, but it's a long process.
So now I want to come back to what you mentioned with Stefan Miran. And I would like to know from you what this 1985 Plaza Accord that successfully devalued the dollar back then, but contributed also to Japan's lost decade, could be a parallel to today. What can we learn from the Plaza Accord? And how do you think that Stefan Miran's proposed Mar-a-Lago Accord could repeat maybe that mistake if it was, but this time in reverse for the US?
So the Plaza Accord occurred. It was 1985, and that was much earlier in the system, where there was way less debt in the system, and the trade deficits were a lot less cumulative than they are now. And so what happened was, as people know, in the late 70s, early 80s, Paul Volcker jacked interest rates up really high to basically try to stabilize the dollar, and that eventually resulted in a very rapidly strengthening dollar compared to other currencies. So in the 70s, the dollar was kind of weak. There's even a period where the U.S. issued foreign currency bonds. We issued bonds denominated in Swiss francs and German Deutschmarks. People called them Carter bonds to kind of dunk on them. And it's not a good look when you're issuing, like, it's like an emerging market thing to issue debt in some other currency. But by the late 70s, early 80s, we started to stabilize, and then so the early 80s, kind of the call it 1980 to like 85, it was a very rapidly strengthening dollar. And then we had a similar thing to now, which is that like U.S. exporters are like, what are we supposed to do with this? Like the dollar just like doubled compared to other currencies, and we're trying to build cars here and like send them to the rest of the world, and now they're like twice as expensive. At the time, Japan was the big trade boogeyman. That was the one that like Japan's taking over the world. They're better at everything. They're exporting everything. How can we compete with them? And they're like unfairly weakening their currency. These were all the narratives at the time. And so the U.S. basically got a bunch of its allies together and said, look, we're going to arrest this like rapidly increasing dollar. We're going to bring this down. You're going to help us. And we can basically force you to help us. I mean, Japan was basically a vassal state. Germany in a similar way. So they got their allies together and said, look, for all of us, we're going to do an organized devaluation here, and that contributed to Japanese bubble in the late 80s and eventually to their lost decade. I don't think that was anywhere near the only cause of their lost decades. In fact, that was more of a demographic and other issue. This just affected somewhat the timing and the size of what was happening. I think a big difference than today. One is that was a devaluation among our allies. U.S. and China are not really allies, and China is huge in terms of population, in terms of economic size. By many metrics, they're bigger than us. Other metrics, they're number two. So depending on how you look at it, they're the number one or two size economy in the world. They're the biggest trading partner with the majority of countries in the world, which was not the case for Japan. Um, Militarily, they're pretty significant as well, especially compared to Japan back then. So multiple metrics, they're different than both the Soviet Union at the time and different than Japan at the time. Another factor worth pointing out is that while the Plaza Accord did weaken the dollar, it didn't, we still had trade deficits. And if anything, by the 90s, they accelerated with various agreements. And so while that's I do think we'll have probably some currency accords ahead or basically controlled exchange rates and things like that. That's only part of the fix. And it's much harder when you're dealing with a rival economy that is roughly your size and not on the friendliest terms.
So would you say, like, now that where we're standing now, it's too early to say how this will turn out to be, like this U.S.-China trade war? There's been a truce that's been announced yesterday about lowering each other's tariffs. You said in your newsletter that this is just changing the players, but not the game, right? Would this be an accurate observation for this stage of the ongoing recalibration of trade?
Yeah, so I mean, the 100+% tariffs that the U.S. and China had recently, that was basically an embargo. Like you can't operate a business like importing and exporting things with that kind of numbers and that kind of uncertainty. So there are a lot of things that were just frozen. Bringing it down to 30% for U.S. and 10% for China makes that more functioning. In the meantime, as these ongoing negotiations continue. But yeah, I don't think that will meaningfully impact the overall U.S. trade deficit. And to use the hate the game, not the players reference, basically the point of that is to say that the single biggest reason why the U.S. has a trade deficit is not unfair practices by our competitors. And not to say that's not an issue. That's not the main reason. The main reason is what I said before, which is that if we want the world to use dollars as the global reserve currency, there has to be a mechanism for them to get all those dollars. And the main mechanism is trade deficits. And that's just the way the system's been structured. So partially, a big component of fixing the trade deficit is ironically making the dollar less attractive as a global reserve unit. And that's why Stephen Myron's paper directly says maybe we should put fees on using the dollar. And make them, encourage them to use other assets. Not to say we don't want them to use any dollars, but we don't want the entire world primarily using the dollar for everything. Another way to describe that is to basically say you can have a multipolar world. You can say, well, look, China, you're lending to other countries. You're trading with your nearest trading partners. Maybe you should use your own currency for that rather than the dollar, right? To basically say, look, in the East, maybe that's the global reserve currency over there, while the dollar is the biggest one in the West and still the biggest one globally, but not as like extremely concentrated. I think one of the biggest challenges with this administration is they want both, right? They want to have the dollar stay the reserve currency, not give any ground there, but then they also don't want trade deficits, and trade deficits are what provide dollars to the world to use as the global reserve currency. And I think that and this happens to politicians a lot, there's not an acknowledgement of trade-offs. It's like they can say we can have everything and give up nothing. Whereas in reality, explaining this to people is really hard, and it shows up in papers by like Stephen Myron because he's mainly talking to academics and other people that are looking deep into this. It's not something you bring up at a political rally. It's not something you bring up on CNBC when you're talking, to hosts in a 10-minute interview. And that's the challenge of it. It's wonky, but it's real.
So you just also mentioned this. There's like this dichotomy almost And the overvaluation of the dollar is also tied to its strategic dominance, right? We're talking about 750 US bases, all of that. All those things need to be financed. So can we realistically say that the US can keep its financial extraterritoriality in a way and restore in the same time as well its manufacturing base, or is it a zero-sum game?
I think that is mostly a zero-sum game. I think the world as a whole is not a zero-sum game. There's plenty of ways for us all to grow together. But that specific trade-off is pretty tight, which is basically that if you want the dollar to be by far the dominant currency for all the things I just mentioned, that's going to overvalue it, and it means that those countries have to be supplied with dollars. And so the combination of the dollar being overvalued and them needing dollars results in big trade deficits. Now, it's not like an on and off switch. It's not like you're the globals of currency or not. You can have two or three competing global reserve currencies that are all kind of dominant in their regions. For example, so the U.S., instead of being 90% of every trading pair, the dollar could fall to 70% or 60%. That's still significant, but it's not as dominant. Or, for example, instead of being like 2/3 of global reserve assets, it could fall to like 40%, but it could still be the biggest one individually, right? So if Chinese currency goes up to 10% of reserve holdings and the dollar falls to 40%, with others being, the euro and others, that's still a reserve currency, even though it's just less dominant. So I do think it involves trade-offs there in a more multipolar world, and I think that's kind of a fundamental rebalancing, which is that after World War II, we were in a very single pole world. The U.S. dominated by many fronts. We were like over 40% of GDP, by far the biggest military, biggest industrial base. And then for decades, the only partial rival was the Soviet Union, but the size was always in the U.S. favor. And then particularly once the Soviet Union fell, 3.5 decades ago, we were in a true single polar world for like the 90s and the early 2000s, whereas the U.S. was kind of by the center of everything. Whereas now we've seen the resurgence of China, resurgence of India, and other places, which is actually more of a natural state of affairs. I mean, the U.S. population is like 4% of global population. Before the 1800s, like opium wars and things like that, China was a really big share of global GDP just because of the population and other things going for them. Same thing for India, used to be a really big share of global GDP. So we were in this kind of period of time from like the early 1800s to like pretty recently, where the U.S. and more broadly the West was the center of everything. And now we're kind of going back to the state that existed prior, which is that there are multiple poles in the world. There's less of a clear center in the world, and I think that over time, currencies and trading systems will increasingly reflect that. I think that it takes time to catch up to that reality because currencies have network effects. So it happens with a lag, but it does happen over years and decades.
So if we now look at what you just mentioned, India, Russia, China, we're talking about BRICS since the last decade, at least 15 years. And that's also, I guess, part of this recalibration. How do you see it evolve on that side, on the Indian side, the role of India, the role of Russia? Louis Vincent Gave, who I had recently on the podcast, was also saying that he sees really that huge block of three countries, the R, the C, and the I in the BRICS to be kind of like the most dominant part that will drive the next coming decades.
Yeah, I think they're all major players, but obviously Russia is a huge provider of natural resources and has a significant military and its geographic size. India, along with China, one of the most populated countries in the world. I think they're number one now by most estimates, and a younger demographic, so they're still on the upswing significantly, even though they're smaller economic size significantly. And then China, even though they have now issues with aging demographics and things like that, they're an industrial powerhouse and increasingly a military and economic powerhouse. And then you add Brazil and some others, and it's a pretty big group. I think the way we're seeing this play out is that there's multiple groups that matter. So the Association for Southeast Nations, so Asian, they recently did an announcement that also they called the Asian +3 because it adds South Korea, China, and Japan, which are not part of Southeast Asia, but they basically paired with those three East Asian countries. And they have a lot of initiatives together. They have kind of an alternative for the IMF. So this kind of pool of capital to kind of bail out little trouble areas whenever there's a problem. It's kind of a free trade zone in many ways. And so that's kind of this really big economic block that matters. Then there's BRICS. That's, it was initially an acronym to describe them, but then they kind of took that term and said, yes, we are the BRICS, and we have a BRICS organization now. And so that's a meeting that kind of includes more than just that Southeast Asian part. And then there's also the Shanghai Cooperation Organization, which includes much of Asia and elsewhere. So through these different organizations, they are gradually building more connections between each other. Now, it's not without frictions. It's not like this is like, there's more frictions between these countries than, for example, there are between Eurozone countries. Like China and India are not on good terms in many ways. They're kind of frenemies in a way. They literally have some border like skirmishes and border issues sometimes. India is on pretty good terms with Russia. Partly, I guess it's one of those things like if you don't border someone, sometimes it's easier to be friends with them. Like India and Russia have less to argue about, and so they've actually built some pretty significant economic ties. And so I do think that overall, looking at economic size, Russia, India, China, and then to a lesser extent Brazil and others are the kind of the key points there. I would add to that the Middle East. The major oil producers, who Saudi Arabia aligns with. The UAE is a big deal, even despite its relatively small size. These are linchpins that matter because if you look at, say, China as an economic power, what is its main weakness? That it needs energy, for example, and that's where Russia comes into play. That's where the Middle East comes into play. They need food. That's where Brazil also comes into play. And so as China builds these economic and trade bridges with these other significant powers, they kind of round out a really self-sustaining currency block, which gives them a lot of leverage.
Now, if we look at the bond market, it's kind of center piece of the monetary system. It's the ballast of a diverse portfolio for quite some decades already. And it's an anchor of sovereign finance as well. But it's also a refuge in crisis. And recently we've seen with the US government debt that exceeds $34 trillion, over $1 trillion in annual cost at least. Foreign demand of US treasuries, as you mentioned, weakening, especially with China and Japan. And then also the Federal Reserve and the Treasury increasingly intertwined. That also raises concerns about monetary independence and inflationary repression as well. How do you see that fold out? There's some even I've seen come across articles about the death of the bond market and all kinds of videos about that. Is that an exaggeration? Is this just a temporary dip? What do you make of it?
I think it's a structural trend change. I think the 40-year bond market bull market ended. So from the early 80s all the way up into the early 2020s, we were in a period of structurally declining interest rates in the U.S. and many other parts of the world. And with structurally falling interest rates means structurally higher bond prices. We bounced off zero and are now kind of trending sideways. And I think that's a persistent change. There's less of a bull market that can happen if you drop from 4% to zero than from 20% to zero. So even the bullish scenarios are not that bullish anymore. And then some of the bearish scenarios, especially including like just inflation and debasement, are pretty negative. A comparable period is to look at from the 40s through the 70s was a terrible multi-year decade for sovereign bonds. Interest rates were rising. The 40s and the 70s are both inflationary. Even the 50s and 60s that were not really inflationary, it was better to own most other assets than bonds. Nominal GDP in the U.S. was growing faster than interest rates. It was just better to own equities and other things. And so I think we're kind of in that kind of same period where like for decades, bonds are just not going to be one of the best investments you could have, which was not the case in like the 80s and 90s. On a risk-adjusted basis, they were amazing. High yields, nominally risk-free, did well in a recession. That was a great asset. And I think we're past that period. And then in addition, when you look at geopolitical stuff, from the 70s until literally 2009, among central banks, there was decreasing tonnage of gold. They just, dropped their tonnage from their peak down to like 30,000 tons. And then since 2009, that's been building back up. That was the turning point. That's why I describe this period as kind of an acceleration. It's not the initial change of all trends, because some of that happened back in the global financial crisis in the early 2010s. So that's where some of the changes started. But this accelerates that in many cases. So I think that we are seeing a return toward neutral reserve assets as a significant holding of central bank assets. So basically, in a world where the biggest bond markets are prone to persistent debasement with lower interest rates, and in a world where they can be confiscated, gold in the central bank's own self custody is attractive as a sovereign asset. Around the margins, Bitcoin's interesting. It's only a $2 trillion asset, so it's like a tenth of the size of the gold market. It's more volatile. It's only 16 years old, but among some smaller countries, Bhutan, El Salvador, it's interesting to them. It's also a trading mechanism for countries that are sanctioned. It's an open source settlement mechanism that they can turn to, so I do think we're seeing a upshift in the appreciation of neutral reserve assets. Which, going back to that Stephen Myron paper, he called that out. He said basically, as if we make the Treasury less attractive as a reserve holding to make the dollar less overvalued, then this could benefit some other currencies, but it'll probably primarily benefit neutral reserve assets. And he mentions gold and cryptocurrencies, with Bitcoin being the by far the dominant one. And so I think that's the world we're going in, a more multipolar world that is then tied together with some of these neutral reserve assets.
Now talking about gold has been, some would say, overbought. I also think that you wrote this in your latest newsletter. What do you see the price action for gold for the coming years? Did we reach a local top, and will we go then witness a decline, or is it just the beginning of a decade-long bull run?
I think both are true. So I've been bullish and long gold since 2018 publicly. In 2020, when it had that price surge, I did publicly write that I'm a little cautious about it after being overbought, and I think it could cool off for a little while. Now, it ended up cooling off for like almost 3 years, so it was actually longer than I expected. And then it broke out again. So I never stopped being structurally bullish on it, but I was like, hey, it's a little overbought. I kind of like Bitcoin here in 2020 instead. And for the first time, I've kind of had that sentiment again, which is basically to say, gold might be overbought here, kind of like 2020. But it doesn't mean I want to sell it. It doesn't mean I think that the structural bull market is done. It just means it could rest a while, allow the market to digest that move to some extent, build another base, and then go up. I try not to trade assets that I'm structurally bullish on. There's a problem with trading. You can be too cute for your own good, which is like you're like, I'm going to try to time this, and then when it falls again, I'm going to buy more, and then it could just keep running and get away from you, right? Like I could be wrong about this being a temporary top, and it could just surge to 4,000. And if I got out of the market on an asset that I'm structurally bullish on, that's not a good trade. So it's more like setting expectations, setting a base case, but still holding on to things I'm structurally bullish on. So in the 2010s, there were multiple times when the big tech stocks took a breather, but it was still right to just basically keep owning them, tax efficient way. I think that's true for gold now, which is I still like gold more than the bond market. I just think that there are periods of time where everybody likes it at once, and it's time to maybe chill for it could be 6 months, could be 12 months. Back in 2020, it lasted, a little longer than I would have expected. So I don't try to predict the future in that sense. But yeah, I'm structurally bullish, near term, more cautious, potentially a little more bullish on Bitcoin in say the next 12 months. But then just like previously, that'll get overbought at some point, and then I'll probably be like, hey, people forgot about gold again, but it's still doing its thing. So I'll probably switch back at some point.
If we look at Bitcoin's performance in the last months, and also considering the whole turmoil, you could say that for a risk asset, it did pretty well, right? And it also recovered. Now it's above 100K again. Are you surprised? Does this mean that Bitcoin reached maybe, is this actually the case? Could you even say that it changed in the way that Bitcoin behaved as a risk asset in its nature, or not at all?
So I'm not surprised. I do think that the market is seeing that more. So for much of like say 2020 through 2024, the biggest driver was liquidity, just because there's so much macro stuff happening. It was either like flooding into the market like 2020, 2021, or being rapidly pulled out of the market like 2022, and then like gradually put back into the market like 2023, 2024. And that would make like the Bitcoin and the Nasdaq basically go up and down together, just at different magnitudes. But then there are some things that can negatively hurt one and not the other. And so, for example, if you go after corporate margins, that's worse for the Nasdaq, whereas Bitcoin has no margins; it's money. In addition, it's a global asset. So in order to buy Nasdaq stocks, you got to buy dollars and then buy the Nasdaq. Whereas Bitcoin, even though dollar's the biggest trading pair, I mean, it's a global asset like gold. There's exchanges around the world that you can buy it at. It's not explicitly tied to the dollar. And so we saw, for example, during the initial volleys of the trade war, there were capital outflows. So stocks went down, bonds went down, the dollar went down together, as something you often see in emerging markets when there's just kind of global capital coming out of that market. So we had a little bit around the margin just kind of pulling out. And Bitcoin's a global asset. So much like gold, it kind of held up well in that environment. Another way to describe it is that when liquidity conditions are decent, as they have been, and yet there's other reasons to be bearish. It could be stagflation. It could be trade like tariffs on corporate margins. Then that's good for Bitcoin, which benefits from that liquidity, but it's negative for certain stocks. And I think that's what we've seen. So there are types of things that can decouple Bitcoin from the Nasdaq or from the S&P, and this type of period is one of those. And so I think that's the case. When you're bullish on liquidity, but you're not super bullish on margins, then Bitcoin is often a better play. And there's also like this idiosyncratic things with the market. So there are times where Bitcoin's overbought and it needs time to cool off for a period of time. And we kind of went through that. So it got overbought in March 2024 after the ETF announcements and launch. People were really bulled up and it kind of got frothy. There are multiple metrics I look at that kind of quantify this. And then it went through a 7-month consolidation. And then, when the election happened, it's more pro-Bitcoin, pro-crypto administration. We got another kind of a catalyst to be bullish again, but also we had worked off all of that valuation excess since March. We popped up to something like 108, 109K. We got to similar levels of quantitative frothiness. And so we consolidated, going into April. And a lot of that's worked off now. So it's just partly it's its own kind of market going through periods of overbought, periods of being forgot again. And I think most metrics look at a pretty good place for Bitcoin. I'm pretty constructive with a 12-month view.
Where do you see it within the 12 months, like in the range?
Bitcoin does Bitcoin things. I try not to judge. I think we're going to see new highs in 12 months, within 12 months. I could be wrong, but that's my base case. Something like 150,000 wouldn't surprise me. But I try not to give specific price targets because you can have a liquid moves that bring you up way higher, or you could fail to reach those moves. But I say 12 months is bullish, is my view.
There's a lot of charts going up. Raoul Pal shares regularly. You must have seen it over and over, this M2 correlation chart with Bitcoin. What do you think of it?
So I think there's something to it, but I think you can't over rely on it. So we actually did a study. I partnered with Sam Callahan to have a study happen. And it did show that Bitcoin in, say, 6 and 12-month periods is more correlated with global M2 than other large assets. So it's more positively correlated with it than gold. It's more positively correlated than S&P 500, more positively correlated than bonds and foreign stocks. So about 87% of the time, Bitcoin price will move in the direction of global liquidity within, say, a 6 to 12-month period. And that does not mean that on a week-by-week basis, it'll track it. Sometimes it will, sometimes it won't. And it's not the only variable. So, if Bitcoin gets tremendously overbought, as it has in some prior periods, then even if global M2 keeps inching up, there's a good chance that Bitcoin can correct. So we actually analyzed those 17% of periods where Bitcoin did not correlate with global M2, like, it moved in the other direction. And those were often periods where Bitcoin started that period dramatically overbought. And so basically, regardless of ongoing good news for Bitcoin, it would fall back down because it was starting from an unsustainable position. So I'd say when you look at I would say global M2 and overall liquidity is a really powerful variable to be aware of when trying to estimate Bitcoin price action, but it's one of a handful that you should look at rather than just the only thing and just overlay 2 charts and call it a thesis.
To conclude, my last question is actually from a viewer, and that viewer called LQ Vendor FP is asking about, will tokenized gold ultimately become a good digital alternative to Bitcoin, considering gold has intrinsic value with universal acceptance as a store of value, whereas Bitcoin is essentially supply constrained fiat?
So I don't think so, because we've had gold-backed stablecoins for years now. That they're already out. by a hand. Like Paxos and Tether both have gold-backed stablecoins. I think they're a useful product. I think it's good that they exist. They serve a niche. They're basically, you can think of them as like gold ETFs, except that they're not tied to any one country, right? So if I'm in the U.S. and I have a gold ETF, and I can't really bring that. I have to like sell it and go somewhere else. Whereas if you have that token, you could be in Lebanon and have that token, and you can go to somewhere in Europe and you still have that token, as long as you're not in a place that Tether's like actively sanctioning you, for example, because of government pressure. At the end of the day, it's still a chain of credit. It's just a slightly more portable one than say ETFs. So I would say that it's tokenized assets in general, rather whether it's tokenized dollar, tokenized gold, tokenized S&P. The big value there is it allows people in certain markets to access them when it would otherwise be harder to access them. So they do serve a purpose. But it's fundamentally solving a very different problem with Bitcoin than Bitcoin, which is basically Bitcoin is an asset that's not credit. It's not like a token that someone legally owes you something. You hold the key, then as long as the Bitcoin network is functioning, you're the only one that can control that Bitcoin. You can self-custody it. And so it's kind of like physical gold in that sense, with pros and cons. Like, gold has thousands of years of history, it's physical, whereas Bitcoin is portable. So, for example, when I go back and forth between the US and Egypt, I can't realistically bring my self-custodied gold with me, but I can bring my self-custody Bitcoin with me. Or, for example, I can have a 2 or 3 multi-sig where I have one key in the US and one key in Egypt and have one key with me, and basically have control of my Bitcoin wherever I am. There are options like that someone can do that you can't do with gold. So different assets, different purposes.
Great. We have just under a minute left, and I was wondering if there's maybe one asset that you think is highly underappreciated or in the blind spot of the market at the moment. Very quick.
Ironically, Bitcoin. Bitcoiners are focused on it, but TradFi, because it's been flat since November of last year, it's off the radar. Also, I think that like Brazilian stocks, for example, there are certain emerging markets that I'm bullish on with a 5-year view that just they're completely underowned. Nobody cares. No one talks about them. You won't see them on CNBC, and so they're pretty I'm pretty bullish on them.
Great. Awesome. Lyn, as always, it's been a great pleasure speaking with you. I wish you all the best.
Yep, great talking to you.